Chapter 10, we're going to be talking about financial planning with life insurance. And I realize that at your age, the majority of you are not even considering life insurance. But as you graduate, you get married, and you start having children, this is something that you do need to consider because it's not to protect you, but it is to protect your family. So when you join when you purchase a life insurance policy, what you're doing is you're joining a risk sharing group, and you're purchasing a contract. And what you're doing is you're saying that the insurance company is promising to pay a sum of money at the time of your death or your spouse's death, but in return you have to pay them a premium, monthly, quarterly, or yearly, to have this guarantee. So what is life insurance? It's just a policy where the company promises to pay a lump sum to the named beneficiary, and generally that beneficiary is the your spouse, or if you're not married, it's your parents, or if you have a minor child, it could even be them. They're promising to pay them, again, a lump sum at the time of your death. And then the primary purpose, of course, is to protect someone who depends on you for financial loss. This slide just shows what you could use purpose of a life insurance. You could pay off mortgages and debts. You could give it as a lump sum to your children. You could set up an educational fund for children, charitable donations, and things like that. The mortality tables, and it is shown on page 322 of your book, provides you at the odds on your dying based on your age and sex. Basically, at your age, what is the norm that most people would die? Doesn't mean that you're going to die at that age. You might die early, or you might even die later. The premium is the cost of the policy, and it is based on your life expectancies and the projections for the payout for the person who dies. So the younger you are when you purchase a policy, the cheaper it will be. If you wait until you're in your 50s, then your policy is going to be more expensive. Questions you need to ask about life insurance. Do you have people who you need to protect financially? Are you single and have a lot of debt? And do your parents, relatives, or a charity that you want to support? So if you answer yes to any of those questions, then you need to think about a life insurance policy. There are 4 general methods to determine the amount of insurance that you think you might need. The first one is the easy method, and what you would do to determine how much you would need would be you would take 70% of your salary for 7 years while your family adjusts. And what that does is it just helps you know how much that you would need for your family to be able to adjust to not having that income. But now it does assume that this is a typical family, and a typical family is generally 2, maybe 2.5 children. The DINK method is if you have no dependents and your spouse earns as much or more than you do, then it's very simple. All you need to do is to ensure that your spouse is not going to be burdened by the debts should you die. You need to basically make sure that it covers your funeral expenses plus half of what debts you currently have. And you might even want to look at, if you haven't bought a house, well, you would need to consider how much they would need to help pay that mortgage payment each month. The next one is the non-working spouse method. And how you're going to do that is you're going to estimate how much insurance a homemaker, whether it is male or female, because in our society today, we do have non-working males who stay home and take care of children. You would multiply the number of years before your youngest child reaches 18 by $10,000. So for that, if you had a 5-year-old, you would have to multiply um, $10,000 times 13 years. And so you would need at least minimum of $130,000 just to cover the non-working spouse. And then the family method is the first three methods assume that you and your family are typical and ignore such factors as social security, income, and assets, and the rate of money that you would leave behind. So those four, you would kind of need to look at where you're standing and figure out how much insurance you think you need. Typically, most people are going to go for anywhere from $50,000 to $100,000 to start off with, just to make sure that they don't leave their family burdened financially. There are two types of life insurance companies. The first one is stock life insurance, and it is owned by shareholders. And the other one is mutual life insurance companies, and they are owned by policyholders. Um, Again, the stock life are owned by shareholders. Now, this slide tells us that 95% of insurance companies are stock life, but your book on page 325 says 75%. So I would have to do some research to see which one of this is the correct percentage. I would probably go with the 75%. Um, Stock Life, they sell non-participating policies. And if you want to pay the same premium each year, then you would choose a non-participating policy with guaranteed premiums, which means if I chose a $100,000 life insurance policy and my premium was $498, it would always stay $498 unless I increased my coverage. The mutual life insurance companies are owned by policyholders. And again, this slide says 5% of policies are from this type, but our book says 25%. These policy premiums are generally higher than non-participating, and part of the non-participating premium is refunded to the policyholders annually in the form of a policy dividend. But then do remember that that dividend would be divided among everybody that was in with that mutual life policy. So now let's talk about the types of life insurance policies that you can choose. First of all is term life. Then we have whole life. We have group life. We have credit life, and we have endowment life. So let's begin talking about term life insurance. Okay, term life insurance, again, is called temporary life insurance because it is only for protection for a specific period of time. Generally, it's 1 year, 2 years, 5, 10, 20, no matter what age you take it. At age 70, it is then discontinued. You can no longer buy any more protection after 70. And the reason they do that is because term life is there to protect your family when they need that protection the most. When you get to be 75, 80 years old, generally your family is on their own and they're taking care of themselves, so they don't need that life insurance. Another thing about term life is that if you stop paying premiums, the coverage stops. If you miss a premium, then you no longer have insurance. So you have to be very, very diligent and make sure you pay those premiums. Now, there's some other types of term life. There's renewable term. And what that is that the insurance ends at the conclusion of the term. but you can continue it for another 5 years, 10 years, or whatever. Again, once you reach that age of 70, it is discontinued. Multi-level is probably the most popular, and because it has straight term, meaning that you're only going to pay the same premium year after year after year until you reach 70, and then again it's discontinued. um, Conversion, it allows you to change from a term to a permanent coverage, but it will have a higher premium. Decreasing term, it's that pays less to the beneficiary as your time passes. So you might start off with 100,000, and then as you got to 50, it might go down to 75, 60, 50, until you reach age 70, until the loan. And then return of premium. Recently, this is when insurance companies began to sell this policy. And what it does is it returns all the premiums if you survive till the end of the policy. Premiums are much higher than regular term policy, but you do get your money back if they don't have to pay out those premiums. The other type of major insurance policy for life insurance is known as whole life, or another term is straight life policy. What it is, it's a permanent policy for which you pay a specific premium each year for the rest of your life. In return, the insurance company will pay your beneficiary a stated amount, and again, it will depend mostly on the age when you start the policy. It provides death benefits, and it accumulates a cash value. Now, one thing you want to know is that whole life policies are popular because they provide both of those, the death benefits, or it's kind of a savings component that you can borrow against the cash value or even draw it out at retirement. Remember, though, that your primary purpose in buying life insurance is not for an investment, but to protect your family. So look carefully at the rate of return on your money owes. On page 327 of our book, in the Did You Know section, it kind of gave you a little bit of an idea. It said that 146 million individual life insurance policies were in force at the beginning of 2013. Of the new individual policies issued in 2012, 64% were whole life policies. So that kind of gives you an idea of, do I want to buy a term life or do I want to buy a whole life policy? Some other options for whole life policies. First one is limited payment policies. What this one is that your policy charges, your premiums are charged only for a certain period of time, 20, 30 years, or even a specified age, 65 or 70. Once you have either paid it for 20 or 30 years, or you've reached that age, then your policy is considered paid up, and you'll remain insured for the remainder of your life. Now, keep in mind that your annual premiums are going to be quite a bit higher, because it has to be paid within a certain amount of time for them to recoup their money. So you have to think about that if you're looking at a limited payment policy. A variable life policy is your premiums are fixed, uh, and with a cash value policy, part of your premiums is placed in a separate account, and then it is invested into the stock market, which means I'm going to have a minimum death benefit guaranteed $50,000, but the benefit could be greater depending on the earnings of the dollars invested in the separate fund. So the ups and downs of the stock market will influence how much your earnings on that policy would be. Two other whole life policy options that you might want to consider is an adjustable life policy. And what this one allows is a change in premium payments or the period of your coverage as your needs change. So, um, for instance, if you're married and then you get a divorce and you don't remarry for a longer period of time, you could change the amount of coverage that you needed, because if it's just you, you would not need as much coverage. Another one that is popular with younger people is a universal life policy, and it is a term life policy, but it has a cash value, and you can borrow against that cash value. So you could consider that. But again, your premium amounts can be changed at any time without changing your coverage, because part of your premium goes into an investment account. On page 328 of your book, Exhibit 10.3 gives you some comparisons of the major types: term life, whole life, and universal life. These are some things that you would not need to look at. Print that off when you're talking with an insurance agent, so that you know a little bit about what type of policies that they are offering you and what are the benefits of each type. And finally, talking about types of life insurance policies, there's group life, credit life, and endowment life. Group life insurance is a term insurance, and most of the time you are offered this it's provided by your employer, and they generally will pay the premiums, and no physicals are required for that. Credit life is used by insurance companies to pay off debts if you die. When you go take out a mortgage or a car or buy furniture, they will offer you credit life because it protects the lenders. But notice right here, it tells you the bottom line. It's expensive protection. It does cost, you pay for it every month when you pay that payment, the mortgage, car, whatever, you are paying an additional fee for that one. And then endowment life insurance provides coverage for a specific time, agreed on for a period of time, and that the policy is in effect. This is the comparison, Exhibit 10.3 I was telling you that you would need to look at. This would, to me, would be an excellent handout to take with me if I'm talking with an insurance agent.
And start spending money that you don't have even more. All right, checking in with the email bag, Tyler from Massachusetts writes, many people have a long-term need for life insurance. How can you recommend term to everyone? Don't you feel like you're giving them bad advice? Their term life insurance will likely expire when they need it most. Spoken like a great life insurance agent. Tyler, how long have you been selling life insurance? And those weren't questions, those were passive-aggressive statements, weren't they, sir? So let's deal with it, though. I can easily recommend term life insurance as the only thing, because the rest of it's garbage. It's a ripoff. You're much better off buying term insurance at about 5 cents on the dollar for the same amount of insurance, and investing the rest of your money. You'll end up with much more. Let's kind of follow this through for a second. You'll see what I'm talking about. Let's say I'm talking to a 32-year-old who has a 4-year-old and a 2-year-old. Let's visit him 20 years from now when his 20-year level term that I recommend expires. That would make him 52. He would have a 24-year-old and a 22-year-old. They should, hypothetically, both be out of college, both be grown, gone, out of the picture, no longer a liability. The kids are grown and gone at 52 for that 32-year-old 20 years from today. Let's see. His house would be paid for, because you never heard Dave Ramsey ever recommend a mortgage more than 15 years. So in 20 years, he will have been debt-free for 5 years, house and everything. Something to think about. Now, let's see. Would he have anything in his 401k? Well, if he's been investing what I teach, 15% of his income until he was debt-free, and after that loading up on everything, if he made an average household income in America of $40,000, what would he have 20 years later, well, he'd have somewhere between $500,000 and $700,000 in his mutual funds. Now, let's see, he's 52 years old, the kids are grown and gone, the house is paid for, there's $700,000 in mutual funds. He dies with no life insurance. See, his wife's got no kids, no mortgage, and $700,000. I think she could struggle through, Tyler. That's how I recommend term insurance, because I recommend doing a financial plan called getting out of debt and investing, along with the idea that your term insurance is going to expire. And then if you want to keep some term insurance and you're healthy, you may choose to do it. I have absolutely no financial need for term life insurance. A little bit for some estate planning things that we're doing, but very minor. The term life insurance I have is very simple. It's so cheap at 47 years old in the great condition that I'm in, haha, and I don't smoke and I don't do all these crazy things like jump out of airplanes, so I can get term insurance for nothing. And it's so cheap, I keep several $1,000,000 on me extra, just SWI. Sharon wants it. She'd rather have that than another thing on her finger, you know? All right, we'll be right back with more of your emails.
So when you sit down and talk to an insurance agent, some things that you need to be aware of and ask about. First of all is your beneficiary, and that is the person or persons you designate to receive the proceeds from the policy. You need to have a contingent beneficiary who is someone or more than one person should you and your spouse or you and your children all die at the same time. Another thing is that you want to check about the incontestability clause, and that is a clause that after the policy has been enforced for a specified period, the insurance company cannot dispute its validity for any reason. Another thing is you want to look at the grace period. A grace period generally will allow 28 to 31 days to lapse without a penalty for the payment being late. And then you want to look at a reinstatement. Uh, is there a policy that would put it back in force, or can it be turned in for cash? You also want to look at a non-forfeiture clause, and this prevents the forfeiture of your benefits if you choose to drop your policy. The next thing is a misstatement of age provision. And if the company finds out that you have stated your age incorrectly, what it's going to do is pay whatever the benefits would have been at the age you should have listed and not what you did list. And then the policy loan provision. Is it available on whole life endowment policies after it's been in force for how many years? Another thing, and something we don't like to think about, but you know it's real, it's part of life, so you have to think about it, is a suicide clause. Most insurance companies have a provision stating that if the insured dies by suicide, the death benefit will equal only the amount of the premium paid during the first 2 years of the policy being in force. And then we're going to talk about some policy riders, and what these are. They are It's a document that's attached that modifies the coverage or benefits on specific topics. Some of the other policy riders that you would like to consider would be the waiver of premium disability, which means that should you become permanently disabled before 65, then you don't have to pay your premiums anymore. The company will just assume those payments until you reach the age that the policy is stopped. Then the accidental death benefit that you could consider means that should you be killed in an accident of any type, it would pay double premiums. The guaranteed insurability option just basically says that as you get older, if you want to increase the amount of coverage, they have to insure you without a physical. Cost of living protection just means that as the rise in cost of living increases, then your premium, I mean your policy benefit would increase. Accelerated benefits are also called living benefits, and that would allow you, if you became terminally ill and you needed the money, you could get your policy benefits then. And then the last one is the second to die option called survivorship. And what that does is it insures two lives, usually the husband and the wife, and the death benefit is paid when the second spouse dies. So now that you know the ins and outs of life insurance and you're ready to go out and buy a policy, there's some things that you should look at and consider. First of all, where are you at right now, and where do you want to be in 10 years as far as your income? Do you have other savings and income protection? Does your company offer group life insurance? What about pension benefits? Social, if you're an older student and maybe even getting closer to retirement, how close are you to your Social Security? What are you going to be able to do with those? And then the financial strength of the insurance company that you are considering. Determine who you want to buy your policy from. Look at both private and public. One of the best things you can do is research, research, and research. And here's some information that you could look up on the web. Talk to your friends, your colleagues. Ask who they have. What amounts of policy? Do they have a term life? Do they have a whole? Or do they have universal? So ask other people. Ask friends, parents, neighbors. Is the agent available when needed? Does the agent advise you to have a financial plan? Are they pressuring you to purchase more insurance than you feel like that you need? Does the agent belong to professional groups? That's very important. And then do you feel like they're taking time to answer your questions? If you showed them the handout I told you to look at, would they be offended that you had done a little bit of research? Compare policies and cost. Interest minus adjusted index. Look at all these when you're looking at insurance policies. So now that you've decided, okay, I'm going to buy a policy. So you have some steps you have to do. First thing is after you have selected your agent or who you're going to purchase your policy through, you've got to do an application and apply. The second step is you're going to have to provide medical history. Now, if you're getting group insurance through your company, generally you're not going to have a physical. But if it's an individual policy, they generally send someone to your home and they will give you it's not an intensive physical, but they will give you a physical, take blood pressure, different things like that. Read every word of the contract. Remember, you have a 10-day, what is considered a free look period to change your mind. So after 10 days, if you don't feel good about taking out that policy, you need to cancel it. Give your beneficiaries, and if you have a lawyer, a photocopy. If you don't have a lawyer, make sure that you have this copy in a safety deposit box where someone can get their hands on it should something happen to you. You will also have to choose a settlement option. How do you want your money paid out? Most common, of course, is lump sum payment that would go directly to your beneficiary. You can also choose to have a limited installment plan, which would mean that your spouse would get equal installments for a specific number of years after your death. Most common, it's 10 years. You can also choose the life income option, which would be payments to the beneficiary for life, or you can leave the proceeds with the company and then they pay interest to the beneficiary. Just review these 10 golden rules of buying life insurance. What if you already have a policy and you're considering switching to another company? Here's some things that you would want to think about. You could switch if the benefits that you are going to get exceed the cost of getting another physical and paying policy setup cost. Each company has their own setup cost, and they vary between companies. You could switch because the older you are, the higher the premium, if you are still insurable, and can you get all the provisions that you want or you have with another company. So as we've talked about so far, life insurance is going to provide your family with a set sum of money at your death. But if you want to enjoy benefits while you're still alive, you might consider annuities. An annuity will protect you against the risk of outliving your assets. It's a financial contract written by an insurance company that provides you a regular income. It can supplement your retirement income. It can also shelter income from taxes. If you expect to live longer than the average, then you will benefit most from an annuity. Now, financial planners will tell you to make sure that you have contributed all that you can to your IRAs, your 401s, anything, any kind of retirement benefit like that before. Now, notice they have this in bold, before you consider an annuity. What an annuity does is it will provide retirement income for life. It doesn't stop at age 65 or 70 like term or whole life insurance does. Your interest grows tax-free until the money is withdrawn. And then again, if you withdraw it at an older age, then you're in a different tax bracket, so you're not paying as much tax on it. Another benefit is that there's no maximum annual contribution like IRAs, and then your beneficiary is guaranteed no less than the amount that has already been paid in. Some of the types of annuities, first of all, the immediate annuity, and people that are approaching retirement age can purchase an immediate annuity and it starts providing income at once. A deferred annuity income payments start at some point in the future, and you would determine what that future would be. Um, a deferred annuity purchased with a lump sum payment is known as a single premium deferred annuity. A fixed annuity, they receive a fixed amount for life. A variable means it depends on the investment performance. And then an index annuity is based on the stock market, and it can be included in your IRAs. Um, you're going to pay several charges when you purchase an annuity, so make sure that you understand all those costs before you invest, and the cost will reduce the value of your account and the return on your investment. Here are some of the common costs. First of all, you have a surrender charge, and you're going to pay an amount if you withdraw the money over a certain period. Generally it's 6 to 8 years or 7 to 10 years. So you might have to pay that. Another one is a mortality and expense risk charge. And what that is, it's an annual rate of 1.25%. So your average account value during 20 or for for a year of $20,000, you're going to pay $250 for a mortality and expense risk. Then you have an administration fee, that's 25 to 30, and then generally a percentage of 0.15%, and then you have a fund expense. So they are not free. Don't think that an annuity is free.
Hey, Mary J. from PA. You sent in a question and you want to know from me, why do I not like annuities? How much time you got, girlfriend? Here's the thing. It's not that I don't like all annuities. There are some annuities that I like. I like single premium deferred annuities. I like, if you're older and you have a medical condition, sometimes I like medical annuities. The annuities that I do not like are variable annuities. A variable annuity is like a mutual fund owned by an insurance company. Within the contract, because it's a contract, it's an annuity. Oh, it gets so complicated there. You know, I've written about this in great lengths in my books, on my website, so you can go there and find the information that you want. However, this is what you need to know. Just stay away from variable annuities and you'll be just fine.
Then there are some tax considerations of annuities. The Tax Reform Act of 1986 preserved the tax advantage of annuities. It made it there was no maximum contribution, and again, the beneficiary guaranteed no less than what is contributed. On page 339, Steve Goldberg has written an article. He is a financial advisor, and he wrote about a tolerable annuity. Please make sure that you read that, because we probably will discuss this, whether or not you think you should invest in annuities when we have our Sunday night discussion board. Thank you.